Hi everyone, I'm just going to respond to a great post from Terry today, and he's asked some really good questions, and I think Terry's really sort of grasped the idea of the strategy. And fuck off. Hi everyone, it's Darren from Naked Forex Now, and I'm just going to respond to Terry's post on the thread today. And I'm just going to go through his questions. So, what we're talking about here is the simple trend trading strategy with the really high risk to reward. And Terry points out that he's been testing this with various entries, and he had some really big drawdowns, and also when he stuck with the strategy and kept running it over a long period, the returns were really, really high. And I mean, that is the big thing here. It's about running it for the long over the long haul and not being thrown off by the drawdowns. And you know what I always say is that if you want really, really big returns, which a lot of people are looking for, then a systematic strategy that gives you that is also going to have really big drawdowns as well. The two go hand in hand. Obviously, sometimes you're going to have just good luck on your side, and that's not going to be the case. But if you keep trading for long enough, it's going to happen. And the point. I mean, Terry says he was minus 47R over a 7-week period, but then plus 251R after 6 months. And he says this trading really needs to be looked at over a long period, and that's the point. And but the idea is that really all trading should be looked at over a long period. And if you can do 251R in 6 months, what can you do in 10 years with some moderate compounding as well? Okay, so have you got a strategy that you can trade repetitively and execute in at a sort of consistent level over 10 years? And that's the whole point with these systems, is they're really simple. There's no analysis involved. It's just taking a very simple entry and then holding it for your target and just rinsing and repeating. And if you can do that over 5, 10 years, 20 years, the returns you can make are astronomical. But most people can't. And if you look at the funds that have done really well over 10, 15, 20 years, you'll see that many of them have losing years, but they just keep ploughing on. And in the end, they tend to make really, really big returns. So as uncomfortable it is, it's really good to kind of realise that it's like a fact of life, and it's really, this is one of the easiest ways to become a successful trader. But most people will shy away from that, and they'll opt for a more appealing approach, like something like with a 50% win rate and getting 2-to-1 risk to reward, in the belief that because they're not having the big drawdowns and it feels like you're constantly making small bits of money, that somehow you're going to achieve your goal more simply. And that's just not the case. I'm going to go over some of his questions now. You were doing a TP at 5R and another position aiming for 10R, break even at 5, then move into 5R, then 8R, then having a tight stop at 10R. What is your position size on each of these positions? Okay, so here's the position size thing. Okay, so if we talk about the 10R one, and assuming that you get this 50R drawdown and 251R return over the year. Okay. What you need to do is basically say, forget about the figures and say, look, the consecutive losers, the drawdowns are really large. Okay, so a natural reaction is to somehow change the strategy to avoid that. But that's not what you do. You keep the strategy the same, you just reduce your position size. Okay, so if you have a 40R drawdown and that's too large for you, okay, make your position size a quarter of what it was. Okay, so now your drawdown is only 10R. Okay, and your return, which was 250, okay, is now a quarter of 250 is 63R over the year. So now you've got a 10R drawdown and 63R return. Does that suddenly sound like a much more appealing strategy? You're actually doing exactly the same thing. You've just adjusted your position size. And what most people do is say, okay, well, I'll change the entry pattern to get rid of losers, and that's going to make everything all right. It feels like the right way to think about it, but it's actually the wrong way to think about it. Okay, you kind of have to think in reverse. And, that's something I always do now is if I have a problem, the first idea that comes into my head to deal with it is generally wrong. So I look at the kind of the opposite end of that. So, that's what I would say with the position sizing is, don't be optimal. Always consider that your backtest results are better than average. Okay, so always be conservative with your position sizing. Okay, and reduce it to a point where you're comfortable with it. Because there isn't really a right position sizing. When people say, okay, well, this is my win rate, this is my average risk to reward, this is my trade frequency, what should my position size be? Okay, and then they from that think they've got their position sizing right, and that's completely wrong, because the element in that is completely uncertain and not known is the win rate, because all the win rate is a record of how it performed in the past. And if you think that's what's going to happen in the future, you're wrong. Doesn't mean that you can't repeat a win rate, but you shouldn't rely on it. Okay, so rather than look at it as a precise figure, you have to say, okay, well, I know the possibility of having 50R drawdown is there. Where am I going to set my position size? If you're happy to lose 50% or more, then set it at 1%. Okay. If being 50% of your account down after 7 weeks trading, as in Terry's test here, if that's going to make you, buckle and, the psychology of that, the psychological effect of that is too much, then reduce your position size. So what I'm trying to say is don't try and be precise with it. Think of the big picture. If I'm 47R down, how much of my account am I going to be comfortable with? Okay, and like I say, always be on the conservative side of it. Okay. On the subject of the 5R 10R double entry that I was doing, I actually stopped doing that and just went for one, and that is because I didn't really, my figures weren't showing that there was any particular advantage in managing both those positions, because they were very, very similar. There wasn't much diversification going on there, and if you're going to trade two different strategies, they kind of really want to one strategy to be working really well when the other one's doing really bad, so they kind of balance each other out, if you like. and what I found was when the 5R was doing really well, so was the 10R, and vice versa. So there wasn't really enough of an advantage for doing it. I'm not saying that that's true either, but that was just a decision I came to, and decided just to do the one position. It was also the other thing was it was also quite tricky to manage, with both entries being on the same instrument. So the execution was a little bit tricky on that. Next question is, when you take a long on a bullish close above the 200 moving average and a short on the opposite, have you found any ways to avoid losing trades by avoiding candles that are too large or candles that print after quick deep pullbacks or anything else? Again, I would say completely forget about avoiding losses and changing the entry. It's a bit of an illusion, and I wouldn't get sucked into it. And I would say, pick an entry that you're comfortable with, and that just feels good to you. Okay, obviously test that entry, but like you say, you've tested a lot of entries, and I'm sure you'll find the same as me. It doesn't really make any difference at the end of the day. Obviously, if your entry is waiting for much more confirmation and has a wider stop, then you need to look at what sort of profit target you're setting. But you should do that with any entry anyway. But yeah, don't worry about avoiding losing trades. Look at the drawdown, look at the win rate, look at the returns, and then adjust by changing your position size, not changing your entry. Okay. What are your views on break even at 1-to-1, 2-to-1, or do you think these are too tight for this style of trading? No, there's no problem with that at all. The only thing is it's going to increase your win rate if you do that, but it's going to reduce your profit. Okay, your return, because basically a lot of trades that would have stopped out are being taken out at break even, but at the same time, trades that would have been big winners are getting taken out at break even as well. So it kind of balances out. Again, that's another way of reducing drawdown, but if you reduce the drawdown, you're going to notice your return dropping as well. So then go back and look at your position sizing. Initially on paper, moving to break even quickly is appealing because losses really hurt and you don't have to sit through so many losses. But the other side of the coin is you're going to see trades where you move to break even quickly that go on to really big wins. So decide which one you prefer really on how you quickly move to break even, and pick that one. Do you cancel a pending trade if it's not triggered on the next candle, or wait longer before cancelling? Generally I do, sometimes I don't, and it doesn't really make any difference over a large sample. You'll find scenarios where, I wish I hadn't cancelled that because the next after that one retrace candle it flew. That's just part of the game. That's kind of randomness, if you like. Don't be thrown by that. Would you only enter a new trade after an open trade is at break even, or would you stack if the signal prints again? Not a break even yet. Okay, yeah. The other thing. This is a question about trade frequency. Okay. So if you look at the two extremes of this scenario, let's say one extreme, you take every valid signal, okay, which gives you a very high frequency of trades. And then the other end of the spectrum is you take a valid signal, and if that hasn't stopped out or hit its profit target, you don't take any more trades until either of those happen. Okay, that's kind of the two extremes on adding to trades. Okay, and the high frequency one will have really big drawdowns, but it'll have really big returns because you'll never miss a winner. Okay, and the opposite one where you just take one trade and hold it until it's completed, and then before you look for a second trade. This one will have much lower drawdowns, but at the same time lower returns. There's no right or wrong in this, but obviously each option has its own psychological issues you've got to deal with. Again, it's really a choice, and then when you've made your choice, it's a case of setting your position size correctly. You just need to find a pattern with that you like. Okay, with my 10R trades, I on entering on the 15-minute chart, I take I take all the trades available on each day until I have a winning trade. Okay, and then I don't. Once I'm in a winning trade, I don't add until the next day. So again, it's a personal choice, really. There's no right or wrong with that question. Next question: if the market is chopping around and you get stopped out a few times consecutively, do you have a maximum amount of losing trades you'll suffer, and then hold off for another day? And if these again the following day, would you hold off? Would you just keep going? Okay. Yeah. With this, I just I'm systematic, so I'm not going to do the discretion thing and say I don't like how it's going today, so I'm going to stop trading. And that's because when I tested it, I just took all of the trades. I didn't stop if you were in a losing run. Again, it's something you can choose to do, but what I like to try and do is, I'm thinking about what can you do over 5 years, 10 years, 20 years, and how can you simplify it as much as possible so the execution is simple. You just get up. If it's a valid trade, you follow your model. Basically, you get up and you follow your model each day. If it's an issue having so many losers, can then like I say before, you either reduce your position size or you put a wider stop and a closer target on. So instead of just using a single bar and aiming for 10R, well, give it 2 bars and aim for 4R, and then you'll find that you don't get chopped around so much. I mean, a lot of these things are questions that feel like they need to be resolved, but it's actually just a case of it's more of a psychological urge to change these things than based on data. And if you look at your test, where you had a 47R drawdown and 251R return in 6 months, you realise that that those are brilliant figures, but they're just not perfect. And I think sometimes we try, and when we have a good strategy, we still got an urge to improve it, rather than just saying, okay, well, I'm just going to reduce my position size to until it's a level I'm comfortable with, and then just trade it mechanically. Would you only trade this on yen pairs, or are there others you think it would work well on? It works well on all pairs, but the yen pairs seem to outperform other instruments that I have tested. And what I would say would be, run tests on other pairs and see if they give equally good results. But I think you don't really need, if you're looking to diversify by trading different instruments in Forex, I don't think it's worthwhile, really. So yeah, just I'd go and have a test there and see for yourself. I've only been testing these ideas in the London session. I live in the UK, and so like you, I'm sleeping during the A session. Do you think there are any benefits to trading this up to the close of New York session? it makes little to no difference. Yeah, I've looked at this before. I've looked at just trading one session, or just trading 2 sessions, or trading all of the time. It doesn't really make a massive amount of difference. So I would pick a trading session that fits in with what you're comfortable trading, okay, and then do your testing on there, and set your strategy accordingly. It sounds like you're kind of you're on the right path here, and I think it's probably just a case of you like the style of trading, but the big drawdowns, really high returns, probably make you feel a little bit uncomfortable. So if you look at the recent videos I'm doing, the with a slightly wider stop and a trailing stop, it's the same system. It's essentially the exact same system, but it's just having a much lower drawdown and a much lower return. And the good thing about that is you can then increase your position size. So you essentially get to the same goal, really, but they're just slightly different. And the whole point with doing the really high return one was to stress two or three really key points, and that is that high risk to reward is a strong edge in itself. So if you apply that to any system, okay, it's going to add some edge to it, and to highlight the fact that you need to run it over a long period of time, and to highlight the fact that if you want the really high returns, then that's going to be married with high drawdowns, and if you want really low drawdowns, you've got to expect the size of your returns to come down as well. And the other thing is that entries and indication of trend should be really simple, because simple works as well, if not better, than complex ideas, and simple is easier to execute, so you don't really have any reason to complicate those elements of the strategy. So I hope that helps, Terry. Really sounds like you're kind of on the right path with this, and if you have any more questions or comments, leave them below. And like I said, perhaps the recent videos will kind of give you an idea of where you can kind of set something that really works for you.